Hey guys, welcome. Every quarter, the government requires that anyone managing over $100 million must divulge their portfolio. This allows the public to see what companies they own and what they're dumping. We get a comprehensive outline of how the best investors in the world are positioning themselves. Investors that manage this astronomical amount of money are called super investors. Some of the most well known being Warren Buffett, Bill Ackman, Chris Hone, and one of my personal favorites, Dev Kantesaria of Valley Forge Capital Management. He is a high quality compounding investor with an outstanding strategy. He exclusively focuses on the best of the best companies, monopolies or oligopolies, businesses that consistently compound intrinsic value and have an unstoppable growth path. Imagine investing in a business that is incredibly profitable, has little to no competition, can return the majority of cash flow to the shareholders, and is endlessly undervalued.
And the one that resonated with me the strongest was the Buffett Munger playbook, which is to focus on business quality. So to stay away from short-term trading, which is a type of speculation, and really focus on companies that can compound intrinsic value year after year for many years. It's a much easier way to make money. It's more tax efficient, and it's a more predictable way to make money.
Once you start to examine the way he's been investing, it reaffirms his philosophy. Since Q1 of 2019, he has continually bought more than he has sold. Buy after buy after buy. The buys are in green and the sells are in red. He hasn't sold anything up until 2021 when everything's starting to get in bubble territory. He sold 100% of his Aspen Technology stake after their valuation rocketed to the moon. Moving on to the final quarters of 2021, you can see he trimmed his positions just a little. Now, even when he does sell, it's not a lot. It's not a huge percentage of these companies, even when their valuations are through the roof. In 2023, he changed around his portfolio, selling 100% out of Amazon, Autodesk, and Adobe. While this was not a good time to sell Amazon, he sold out of it to buy Intuit. Intuit has performed incredibly since he bought in the first quarter of 2023, up almost 100% from that time. His current portfolio consists of 8 holdings, and 95% of his money is in 6 of them. That's incredibly concentrated. 33% of his entire portfolio, that's $1.3 billion in one company. For those of you who don't know what FICO is, FICO can be broken down into 2 business segments. Their first being the FICO platform. They supply analytics and AI, enabling business to make calculated decisions. This real-time data provides a significant edge for enterprises, creating a dependence on this information. The other segment is FICO Solutions. These are the experts behind your credit score. They score for 95% of the top 100 US banks, 90% of the top US credit card issuers, and 85% of the top US mortgage lenders. With little competition from VantageScore and TransRisk, FICO is the leader in this expanding market. Credit is impacting ordinary life more and more. Good credit is so important for negotiating loan terms, insurance discounts, lower interest rates, rental applications, and even employment. No wonder FICO is up 27% over the past 3 months, 123% in the past year, and 570% in the past 5 years. It has absolutely skyrocketed since 2022, and Dev Kantesaria still won't sell. Even with a price to earnings ratio of 106, he's still holding on. This is someone who is confident in their choice. The reason he won't sell FICO is because he knows they have pricing power. They have a monopolistic segment of credit ratings. This allows them to continually grow their free cash flow per share. Free cash flow per share is up 26% over the past 5 years. These are metrics of a healthy, growing company. S&P Global is another company with exceptional pricing power. S&P provides financial data, analytics, and research to the global financial markets. This company thrives on the growth of markets. If you think markets will increase over time, this is the stock for you. Their company can be separated into 5 businesses. Business number 1, S&P ratings. The US and the world is driven by credit more than ever before. In order for institutions and corporations to invest in debt, they must be rated. The leaders in ratings of that debt are S&P Global, Moody's, and Fitch. These 3 companies practically rate all of the world's debt. Because Moody's and S&P Global are so trusted, they get a few basis points lower when they rate debt, translating to lower interest rates. Those basis points allow for millions of dollars in savings on any sizable amount of debt. In other words, even if the other companies rated the debt for free, it would still be cheaper to get the debt rated by S&P Global and Moody's. That is an exceptional monopoly. Business number 2, S&P Market Intelligence. This is a powerful instrument that utilizes market data, news, and analytics to track the performance of various sectors and markets. The platform is tailored for investors, researchers, and financial professionals to make precise and informed decisions. The next segment of business is S&P Global Platts. This is another highly scalable data business. They provide real-time news and pricing of commodities. Data for commodities like oil, natural gas, coal, electric power, shipping, metal, petrochemicals, agriculture, and livestock. They cover almost every commodity. They also have proprietary ways of gathering this data, so competition is burdensome. The data can be sold through bulk contract licensing or as a subscription. Their data is widely used by traders, brokers, energy companies, research institutions, governments, and regulatory agencies. While buying and trading commodities can be brutal, this creates a reliable source of revenue. Data is here to stay, and S&P Global knows that. The 4th business is S&P Dow Jones Indices. Most people are familiar with this one. This is the index business, the most common indices being the S&P 500 and the Dow Jones Industrial Average. An index is a statistical measure used to track the performance of a particular group of assets. This allows for monitoring market trends and evaluating performance so that investors can make informed decisions. S&P has thousands of indexes, and the fees for using these goes straight to S&P. Indices provide a concise way to understand market movements and make data-driven decisions. Finally, business number 5, mobility. This is the car portion of the business, and I'm sure you've guessed, no, S&P doesn't sell cars. Instead, this company provides, yes, more data. Formerly known as J.D. Power, S&P Global Mobility focus on these key areas. They own tons of data. It's what this company does. Data around production planning, electric vehicle research, marketing and sales, even aftermarket. Every data point you need to be in the car industry is backed by this trusted data provider. Now, you heard me mention Moody's while breaking down S&P Global. This is because they are a duopoly. Both S&P Global and Moody's are global leaders of credit ratings, research, and risk analysis. Moody's has 2 halves, the first being Moody's Investor Services. This is another credit rating agency. Together, Moody's and S&P make up about 80% of the credit rating agency market share. This expanding industry, overpowered by 2 companies, produces phenomenal economics. This is the financial profile of Moody's Investor Services segment. Here you can see the breakdown of one-time transactions and reoccurring transactions. If you refer to this chart, you can see each one of the reoccurring revenue segments of each portion of business. Furthermore, they have adjusted operating margins of almost 30%. This side of the company has superb margins. Not only is Moody's incredibly profitable, you have organic growth. This means a business's growth comes from internal resources rather than external factors like mergers and acquisitions. This can be attributed to a few things: economic expansion, demanding debt capital to fund business investments, rising prices of about 3 to 4% a year, and boosted participation in developing capital markets. Moody's is rooted into the global economies. Every company uses them. This creates brand recognition and trust, encouraging a sense of normality. This permits them to have complete pricing power.